Hello, everyone, and welcome to today's web presentation. Today, we're going to be looking ahead at 2025, specifically looking at the investment markets. And before we get started on kind of the meat and potatoes of everything, I did want to go over some housekeeping. Um, this webinar is designed to be informative in nature and not to recommend a strategy or give any advice. The hosts of today's webinar are Dave Treadle, Chip Highmiller, and myself, John Amato. An important reminder for all investors, your long-term strategy should be based on your financial plan. Your portfolio risk and return are based on your stock bond mix, and research has shown that portfolios benefit from a globally diversified approach. Chip, I think it's a great time to come on here and give a big beacon welcome to our newest team member. What do you think?
I think that's a great idea, John. We're really excited to have a new addition to our team. His name is Dave Treadle. He is a great addition for us. He's a wealth advisor. He has tons of experience in the industry. He's worked at Schwab, who we use as our custodian. He's also been with Wells Fargo, and he has a CFP designation and just has a real deep, vast knowledge in lots of areas of planning and investments. And we're so happy to have him. Dave attended Penn State University, so he's really excited about the football run that's happening here, and I'm excited for him, and I hope that they do well. So we're super thrilled to have Dave, and look forward to all the things that he can provide to our clients. And so with that, I would like to introduce Dave, pull him on here and have him kind of go through and just talk about investing and some of the things that we're seeing right now and go through that and give us that knowledge. So Dave, welcome to the webinar and good luck to you. It's going to be great.
Thanks so much, John. Thanks, Chip. Really appreciate the introduction, and it's great to be here, and Beacon is a great place to be. So with that, I would like to dive into our presentation for today, and I'd like to start by talking about the recent historic performance, specifically year-to-date 2024, and how we've been doing so far through the end of November. As you can see in our chart here, what we're including are some of the major segments of the market, both the equity market and the fixed income market. And in that year-to-date category, what really stands out is that everything is positive. And it's really positive for those US-based companies in the equity sector. So you might be asking yourself, the past few years have been pretty wild with a pandemic and with a lot of other events happening in the market. But large U.S. equity seems to keep chugging along. And we kind of wanted to spotlight what's been happening most recently with the concentration and the main performers that have been driving the market, which are known as the Mag 7. And those consist of Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. And these are all those mega large US companies. So the returns chart on the left is since 2021. The green line is the Mag 7. The black is the S&P 500, and the blue is the S&P 500X, the Magnificent 7. So you could see how much of a contribution to the upside the Magnificent 7 has had to returns. But you can also see in 2022 via that chart in the upper left corner that they've also contributed to the downside as well. They've really driven performance both to the upside and downside. And you could see that that the S&P 500X to Mag 7 returns in that blue chart in the upper left are so much different than the S&P 500 inclusive of them and the Mag 7 alone. And this is because of how market cap weighted indices work. They give more importance to those biggest companies. You can see from the chart on the right that the 10 largest S&P 500 companies, which include the Mag 7, now make up about 30%, 36% of the S&P 500. This simply means that how they go has a larger impact on the index and can really drive it higher.
Dave, just wanted to chime in here. So, this is a lot of good information that we're going. It seems like, as you stated on the first slide, that U.S. large companies have really done well as of late, and it seems like what you just referenced as the Magnificent Seven, have really driven some of that performance. This is a super interesting chart over here, and I know a discussion we've had in our office a few times. But if I'm looking at this, I'm an investor, is like, man, should I just be focused on US large cap and the Magnificent Seven, or is there a better way?
Yeah, John, that's a great question. And, really it would not be responsible for us to suggest concentrating your portfolio in just a few names for the long run based on these short-term recent performance results. For one, it would subject you to a lot more volatility that may not be appropriate, but would also mean missing out on other areas of the market when things can and will change. So I wanted to show this chart here as an example of how markets can change leadership through time. As you can see, this is since 1974, and there have been extended periods of time where international has led the US. And you could see that through the light blue sections of the chart. That's outperformance of international stocks versus US stocks. And then you could see the dark blue being where US over the past 10 plus years has been in the driver's seat. But we can't say for certain that's always going to be the case. So trends can last, but they also tend to bounce back and forth.
Yeah, certainly. I think that's a great point. I'm glad you pointed that out. So you've given us a little bit of information here. What's kind of the takeaway here? What would you say to investors if they're saying, what can I gather here?
Well, we believe that trying to figure out the hot sector or the hot stock of the market is just a very difficult task that simply no one can tell you with a straight face that they can do consistently. So we need to control what we can control, and that is keeping to our long-term plan. And part of that plan is staying in the market. And this is a mistake we see often. If you look at this chart here, the dark blue bar on the far left is the return of the S&P 500 over the past 20 years. To the right, you can see the returns much lower, and that's just excluding the 10 best performance days of that 20-year span. And if you exclude even more of the great days, you can see that your return actually turns negative on the far right there. So just missing a few of those really good days in the market because you're trying to time it or because of some other feeling or emotion can really have a negative impact on the results that you earn over the long term.
I'll tell you what, Dave, I have seen this graph a number of times, and it never ceases to amaze me. It's one of those things that really drives home the importance of staying in the market, and it's one that I think is really captivating and excellent to show our clients and other folks watching this web presentation. But let's shift gears a little bit here, Dave. A lot of our clients here at Beacon, a big portion of their portfolio, is bonds or fixed income, as sometimes referred. So, Dave, can you touch on some of the highlights in the bond market or the fixed income market for us?
Yeah, sure, John. Happy to. So just bear with me as I get to my point here, but I'm going to go through a little background first as a reminder for our investors out there that bond prices and interest rates are very related. So as you can see from our little teeter-totter here, as interest rates go down, bond prices go up, and the opposite is true as well. As interest rates go up, bond prices go down. So I say this just to keep this relationship in mind as we move on to the next slides, because it really had an important impact on the markets of late. So John, if you wouldn't mind switching to, yep, there you go. Thank you. So what we're showing here is the yield curve for Treasury bonds. So essentially what this is the bottom axis, the x-axis there starts at 3 months, so for very short-term bonds, and goes out to 30 years, so the very long-term bonds. And the y-axis shows the related yield for those different maturity lengths. And so let's start with that gray bar at the bottom. So that represented 2020. That was kind of the low point where interest rates were bottom out at near zero. The Fed was following that, essentially 0% policy. And then because of COVID and all the fiscal stimulus that was added into the markets, what we had was a run in inflation. And so the Fed had to respond. And what they did was respond by raising rates. And where they ended up there is that light blue chart, our light blue bar there as of October 19, 2023. And you can see where those yields from the very short term to the very long term are in that 5 to 5.5 range. So we went to a near zero policy up to 5.5 in a very short period of time. And then since then, the feeling has been amongst Fed observers that inflation is back in check to some degree, and that the economy is maybe softening a little bit. So they have begun lowering rates, and that's represented by the dark blue bar there. That's where we currently are. So you could see from this chart in the past couple of years, there's been a big increase in rates, and now we're starting to come down, which have really had a big influence on the performance of your bonds.
Yeah, Dave, that was kind of what I was a question that came into my mind. I mean, when I think about fixed income, other than Chip maybe, who loves talking about bonds. Sorry, Chip, I had to throw that in. But some people see this as kind of a more and less boring investment. And what we're seeing right here over the last 4 years is some pretty incredible stuff. What you just described, how has that kind of affected the performance of bonds?
Yeah, sure, John. So let's go ahead on to the next slide there. And what we're showing is some performance timeframes of year to date, 2024. This is as of November 30th. Our 3-year returns and our 10-year returns for bonds of different maturity lengths. So we have the long-term bonds at the top, the intermediate in the middle, and our short-term bonds at the bottom. And so what we really want to start with is that year to date. And you can see that performance has shifted back positive in general, which is great. And that is because, essentially, we could attribute some of this movement to the fact that the Fed has started to lower interest rates again, thus rising the prices of the bonds and creating a positive return for investors. But if we look at those 3-year numbers, you can see that most of them are negative. And that's really because it's inclusive of the period where the Fed went from that zero rate policy up into that 5% range. So the rates went up and the bond prices went down. So you can see what impact that has, but you can also see how those longer term bonds were more affected than the short term bonds through the more negative performance. And that's actually as what we would expect to see, because those longer term bonds, because they're have a longer time to maturity, they're actually more sensitive to interest rate changes, and thus will have a bigger response when the yield curve and interest rates change. And then finally, we look at our 10-year performance chart, and you can see it's positive, but not very flashy. We point to the interest rates over the past decade as a large contributor to these results. For a long time, we were doing that zero rate policy, and interest rates were just so low that you were getting maybe around that 1-2%. And, if you had a bank account, you were getting the 0.1 or 0.05% if you're lucky. And then we had the inflation surge and rates went zooming up, but now we have the rates coming back down again. And you can see how all that kind of meshed together and comes together to give us a yield, slightly above 1% for the various bond categories. So that's kind of what performance has been like in the bond market of late. And so to sum it up for bonds, it's the opinion of most economists that we've read that interest rates should continue to decline. And they're saying this because they're seeing moderation in the economy, but they're also thinking that inflation is somewhat under control. And the jury, for a lot of folks, is still out on that, but the consensus seems to be that rates should continue to move down. So if this is right, investors can expect higher bond prices and gains in their portfolio, but lower future yields for their newer bonds. So that's something to keep in mind. And it's definitely something we keep in mind here at Beacon. And we always review our client portfolios to make sure that the average bond maturity makes sense for a given client's circumstances and even their liquidity needs. And then we also make sure that that bond maturity and the credit quality of the bonds inside their portfolio are reflective of their risk profile and investment goals.
Well, thank you for that, Dave. For our Beacon clients that are listening here, it's just a reminder that, your stock bond mix that's in your portfolio is tailored to you and customized to meet your needs. So just a quick reminder there. I do want to give a big thank you to Dave. Thanks for coming on, Dave, and I really enjoyed this presentation. I look forward to being on more of these type of calls with you in the future, and I'm sure that they'll come. But just kind of to give a little bit of our take, just to kind of put a bow on things as Christmas is right around the corner. I just couldn't help myself. But you know, the global economy is complex. Okay, there's many moving parts, and it can be unpredictable. No one really knows how things are going to play out. But the one thing we do know is that something will arise. So let's control the things that we can control. Such as maintaining a diversified approach, low cost investments, tax efficient investments. And just making things that are customized to you. And for our Beacon clients, that's something that we do. And we'll take advantage of any financial planning opportunities that come along the way. So with that being said, I'm going to hand it back over to Chip, and he's going to kind of go into some things that maybe are on our minds as we're heading into 2025. What do you say, Chip?
Yeah, for sure. That's been awesome. I've love working with you guys and preparing for this webinar. It's been great and very informative. Actually, it's just going through and talking with like-minded professionals. But there are some things on our radar kind of heading into the new year. The biggest thing I think is what's going to happen with inflation, and also what's happening, what the Fed's response might be to some of these numbers. I mean, some of the numbers that we're seeing coming out now are inflation seems to be moderating, but there's still some uncertainty around that. And so, there is a chance that the Fed kind of stalls out on their easing campaign, at least for now. But who knows? At the end of the day, we can't really control that. And so I think this webinar is really focusing on, other than just an informational thing, but let's think about the things that we can control. And for us, that's things like your asset allocation, the internal cost, tax efficiency, planning opportunities, all those things. So, those are things that we're can control and want to keep our eye on there. The other thing that we hit on a little bit in this when we were talking about the Magnificent Seven is some of the valuations and some of the main leadership of the market. And those big large cap U.S. stocks have really done well this year, and kind of in expectation of lowering interest rates and a stronger economy and that sort of thing. And so we are focused and monitoring what happens from a valuation standpoint. So we're looking at things like price to earnings ratios, price to book ratios, and how that relates to individual risk profiles of our clients. And a couple of other, I mean, the debt ceiling is still in consideration. I mean, that's going to, you might hear some headlines, scary headlines for that about the debt ceiling. I just think a lot of that's going to be, fodder, and no real, there's not going to be a lot of teeth to that. I think that we'll get all of the debt ceiling issues resolved. But, to me, it's just maintaining that focus, maintaining that consistent strategy over time, and again, controlling those things that we can control, and focusing on our efforts there. So with that, I'd want to say thank you for attending this webinar. If you've stuck around to the end, it's been great. And we're hopeful that you learned a little bit. And a couple of things that we did want to bring up, though, I think, and maybe John, if you want to talk about this, we have a lot of stuff on our website. We try to do a lot of presentations, podcasts, articles. We feel like that makes us better as professionals, and it helps our clients learn and understand. And I think that's super important, especially when things go wrong, right? I mean,
Yeah.
we've seen markets go sideways, markets go down. And, we found, and I think you'll agree, John and Dave, that over time, the clients who understand the natural progression and the way things work tend to fare better. Their investor experience tends to be better. So we want to make sure that we keep things updated and our education, our focus on education is there on the website. So you can use that
Yeah.
QR code there to reference links on our website that goes directly to the educational aspects.
Certainly, Chip, and it's like it says on this slide right here, knowledge is power. And in a world where information is coming at all people 100 miles an hour from 300 different directions, we hope that you can go to our website and maybe get a touch of clarity and maybe some kind of unbiased, just good information, where you don't have to worry about somebody selling you anything or, it being there being a, some sort of other agenda where that might be the case in other avenues.
Absolutely, so important. We want to be that person that provides that communication because we have no hidden agenda and nothing like that. We just want people to understand, and we really try to disseminate good communications that are truthful and effective in helping people.
Couldn't agree more. And just to kind of wrap things up right here, if anything we talked about today kind of prompted a question or something like that, or you're interested in some more information, our website's a great place to start, but you can also reach out to us here by email, and there's our phone number as well. With that, I think we'll sign off.